Hello students, welcome. This is Dr. Mercado speaking, and in this particular lecture we are going to basically be able to complete an entire statement of cash flows. The problem that we're going to be covering is problem 13-1A. By now you should have read the chapter and you can identify that there are so many components to preparing a statement of cash flows. Okay, to me the most difficult section of the statement of cash flows is the operating activity section. I've already covered the operating activity section of a statement of cash flows in a prior lecture. So that way we got that out of the way, and now we're actually going to compile and complete all three parts of the statement of cash flows in this presentation. Okay, and this presentation is for my Accounting 2401 Principles of Financial Accounting class. Okay, so let me jump over to the problem. Okay, there's a lot of information provided to us. We are going to have to analyze. We're not given the information. We're just not going to plug in numbers. No, we have to figure out some of the numbers that we need to utilize in our statement of cash flows using the data provided for our balance sheet section that is provided to us. Okay, so it says statement of cash flows, and we are using the indirect method, which is the method that is most commonly utilized in business due to the availability of information provided in our financial statements. Okay, so we are provided with the comparative balance sheets for Livers Incorporated for December the 31st of the year 20Y3 and 20Y2. Okay, so we have the assets section and the liabilities and stockholders equity section. Okay, very important to note, the first column is the 20Y3. It's the most current year. The second column is the 20Y2. So we're going to compare if we have any increases or decreases from 20Y2 to 20Y3. We're going to be using the comparative information to be able to calculate some of the numbers that we're going to be using. Okay, they provide us with some additional information. It says additional data obtained from the examination of the accounts in the ledgers are as follows. Okay, investments were sold for $175,000 in cash. Equipment and land were acquired for cash. Remember, this is the statement of cash flows. We are interested in knowing what is affecting cash. Okay, there were no disposals of equipment during the year. The common stock was issued for cash. There was a $500,000 credit to retained earnings for net income, and there was a $90,000 debit to retained earnings for cash dividends declared. Okay, the instructions are to prepare a statement of cash flows using the indirect method of presenting cash flows from or used for operating activities. Okay, so I've set it up here. We've got the name of the business, Livers Incorporated. This is the statement of cash flows, and we are doing it for the year ended December the 31st, 20Y3. Okay, so let's begin. We always begin with the operating activities. Okay, always. They have to be in that order. So we're going to start off with the cash flows from or used for operating activities. Operating activities. Okay. Okay. Now down here, okay, I have this diagram, Exhibit 5. I recommend that you have it handy with you. That way you can refer to it. Okay, it's very, very useful when we are beginning to work on the statement of cash flows. They are complicated. They're more complicated than our income statement, statement of owner's equity, and our balance sheet. I think this financial statement is the most complex of them all. So if we're not familiar with it, until we learn this by heart, we are going to be referring to Exhibit 5 for just general understanding of what should we be doing. Should we be adding? Should we be subtracting? The steps involved. So my recommendation, print this out, have it next to you as we prepare. Okay, so the first thing that we have is we are going to bring in our net income or loss. If it's an income, it's positive. If it's a loss, it'll be negative. Okay, so let's bring in our net income. Okay, now we have to go into the problem and locate our net income. Okay, so we must read the problem and we must locate it. And if we read down here, it says that we have a $500 credit to retain earnings for net income. Okay, so my net income is $500,000. Okay, so let's put that in there. Let me just get this out of the way. Here we go. $500,000. Okay. So that is the first thing we're going to bring in, guys. Our net income. Then we're going to have our adjustments to reconcile net income to net cash flows from or used for operating activities. Okay. So now we're going to have our adjustments. Okay. Okay, give me a second here. Used for operating activities. Okay. So this is where we're going to have our adjustments. Okay. So we're going to start off with our adjustments. Okay. Step number 1, we're going to go ahead and we're going to add our depreciation and our amortization of assets. Okay. Do we have any depreciation of fixed assets? Do we have any amortization of intangible assets? That's step number 1. So the first thing we're going to look at is, do we have any depreciation? Remember, when we calculate net income, it's revenues minus expenses. Included in those expenses, we have depreciation expense. Now, depreciation expense is just an internal entry that is being done to account for the depreciation of assets. There is no cash involved. What the entry is basically we debit depreciation expense and we credit accumulated depreciation. Cash is not involved. But because it is utilized in the calculation of our net income, now we have to make an adjustment. Okay, we're going to have to make an adjustment to add that number back when we're doing our calculation of statement of cash flows, because depreciation does not affect cash. Okay, so depreciation of fixed assets, we're going to add it. Okay, it's a positive. Remember, if it's just like that, it's a positive. If it's in parentheses, it's a subtraction. Okay, so do they give us a depreciation amount? Okay, we don't have the expenses. We only have the assets, liabilities, and stockholders' equity. We don't have the expenses provided. But if we look at our assets section, we have an account called accumulated depreciation. Okay, this account keeps track of the depreciation for the period. Now, if we look at it, in 20Y2, we had $500,000, and in 20Y3, we had $600,000. So my accumulated depreciation increased from 5 to 6 in the year. So that means that our depreciation expense for the year is $100,000. How do we get $100,000? Well, we currently have $600,000. And we started off with $500,000. So that means my depreciation increased by $100,000. Okay. And remember, depreciation is added. Okay. So we're going to go ahead and we're going to add depreciation. Let me see. So depreciation is going to be added by $100,000. Okay. And how do we get that 100? 600,000 minus 500,000 shows that we have an increase. And remember, this is 2000Y2, 2000Y3. So we went from 500 to 600. That means it increased by 100,000. So that is going to be the depreciation for the year. Okay. So we're going to add that. Okay. Do we have any amortization of intangible assets? We don't have any intangible assets in our financial statement, so we can exclude that. Next, we go to step 2. Losses on disposal of assets. Okay? Did we get rid of any assets? Okay? If you have a loss, we're going to add. If you have a gain, we're going to subtract. Okay? And why is this? Because this is recorded later on in our statement of cash flows. Okay, if we sold any assets, that is reported. Let's go back over here in our investing activities section. Okay, so if we buy or sell any assets, fixed assets, that gets reported on our investing activities section. So we need to make an adjustment in our operating section for those adjustments, okay? So let's read. It says here that investments were sold, okay? The investments were sold for $175,000, okay? Now let's look at the investment account, okay? Investment account, okay? So last year in 20Y2, I had a $100,000 investment, okay? This year I ended up with zero, okay? So that means that I sold my investment. The investment was in my books for $100,000. I sold it for $175,000. So I sold it for more than what I had it in my books for. So that means that I made a gain of $75,000. How did I get the 75? I sold it for $175,000 in letter A, and I had it in my books for $100,000. So that means that I made a gain on the sale of that investment of $75,000. Okay? So if we have a gain, okay, gain on disposal of asset, I need to subtract that gain, okay, only the gain amount, okay. So we're going to subtract the gain on sale of investments, okay, and it's 75,000. We're going to put that in parentheses because according to the steps, if you have a gain, you have to subtract it. Why? Because we are accounting for the sale in the section for investing activities, okay? So that covers number 2, okay? We sold an investment. So that covers number 2. Then step number 3, this is the one that's a little bit more challenging. These are the changes in current operating assets and liabilities, okay? So let's bring in that category, okay? Changes in current operating assets and liabilities. Liabilities. There we go. Okay. So this is where we have to look at this table down here. That's why I'm telling you, keep it handy. Okay. Now we're gonna go ahead and we're gonna figure out if we have any increases in non-cash current operating assets or decreases in non-cash operating assets. Do we have any decreases in current operating liabilities or decreases in current operating liabilities? Okay, depending what we have is whether we're going to subtract or add. Okay, so we need to be very careful here. Depending on what happens will dictate if we have to subtract or whether we have to add. Okay, so the first thing we have to look at is, do we have any increases or decreases in our accounts receivable? Okay, so let's look at our accounts receivable account. Okay, accounts receivable is right here. Okay, so if we look at accounts receivable, we see that in 2000Y2 we had 400,000 and in 20Y3 we have 450,000. Okay, so I'm no math whiz here, but from 4 to 450, that shows me an increase. I have more receivables this year than I did last year. So I went from having 400 to 450,000, the difference of 50,000. So 450 this year minus 400,000 last year. That means I have an increase of $50,000 in my receivable. Okay, so let's look at our table down here. If we have an increase in accounts receivable, which we do, we have to subtract. Okay, so we're going to go up here and we're going to do increase in accounts receivable. And because it's an increase, we are going to subtract, and that's $50,000. Okay, why subtract? When you look at the table, increases in accounts receivable are deducted. Okay, now we're going to look at the next section. It deals with inventory. Okay, let's look at our inventory account. Okay, We have inventory right there. So inventory last year we had 750. Now we have 770. Okay. So we have 770 this year. We had 750 last year. So that means that our inventories increased by $20,000. Okay. So we're going to go to our table and we're going to locate. If we have an increase in inventory, we're going to subtract. Okay. Increases in inventory, we're going to subtract. Okay. And we're going to subtract $20,000. The next category we have are prepaid expenses. Do we have any prepaid expenses? In this particular balance sheet, we don't have any prepaid expenses, so we can skip that. Okay. Do we have any accounts payable? Okay, let's look at our accounts payable. Accounts payable is a liability. Okay. So, we have accounts payable right here. Okay. So, last year I had 300,000 in accounts payable. This year I have 340,000. Accounts payable is basically anything that we owe. This is debt. So my debt increased from $300,000 to $340,000. So we have an increase. So this year we have 340. Last year we had 300,000. So that means my accounts payable increased by $40,000. So let's go look at our table. If our accounts payable increase, which is what we have, increases in accounts payable, then we need to add. So increases in accounts payable, we add. Okay. So we're going to go ahead and we're going to increase in accounts payable. We're going to add, and we have $40,000. Remember, 40,000. Our accounts payable went from 3 to 340. It increased by 40,000. Okay. The next item we have to look at is our accrued expenses payable. Do we have any accrued expenses payable? Yes, we do. We have one account. Okay, right there. So my accrued expense payable last year was 50,000. This year it's 45,000. So my accrued expense payable this year is 45,000. Last year was 50,000. So my accrued expense payable decreased by $5,000. So my accrued expense payable decreased. So if I have a decrease in accrued expenses payable, I am going to subtract. Decrease in accrued expense payable, we subtract. Okay. Decrease in accrued expense payable, we're going to subtract, and we have $5,000. Okay. Decreases in income tax payable, we don't have any income tax payable provided, so that is all of the adjustments that we have. We have completed steps 1, 2, and 3. Okay, this is very useful. Okay, so now that we have that, we can calculate our net cash flow from operating activities. Okay, so we're gonna add everything up. Okay, and let's see what we get. Okay, we get $490,000. Now I'm gonna go ahead and I'm gonna put this in another color. That way, just it can stand out, and we can not that I want to do that. I want to do this. Okay, that way we can see our totals for each of the sections. Okay, so what did I do? I got my 500,000. Let me get my calculator out. Okay, 500,000 plus 100,000 plus 75,000 minus 50,000 minus 20,000 minus 40,000 plus 5,000 minus, let me see, did I do it right? It's 500,000 plus 100,000. Okay, that's 600,000. 75,000 minus, okay, that was 600,000 minus 75,000 minus 50,000 minus 20,000 minus 5,000 plus 40,000, and that gives me 490,000. Yes, it does. Okay, so we've got this correct. So now we can move on to our next section. Okay, my next section is cash flows from or used for investing activities. Okay, now let's go back and let's look at investing activities. Cash flows for investing activities are the cash flows from transactions that affect investments in the non-current assets of the company. This could be the purchase and sale of fixed assets such as equipment and buildings. Okay, so did we buy any assets? Okay, if we look at letter B, it says equipment and land were acquired for cash. So we bought both equipment and land using cash. Okay, let's look at here. Equipment and land were acquired for cash. Both of those are fixed assets. Okay, now we're going to have to look at those two accounts separately. Okay, so let's look first. Okay, at land. Okay, so insert shapes. Okay, land right here. Okay, so we purchased, it says here that equipment and land were acquired for cash. Okay, so let's look at the first account, land. We had 0 land last year. We have 500,000 of land this year. So that means that we bought land of 500,000. And how do we pay for the land? It says that we paid it with cash. Okay, so if we bought land with cash, what is going to happen to my cash? Is it going to go up or down? Okay, so if we buy something with cash, I don't know about you, but the money gets deducted from my bank account. So my cash decreases. Okay, so I'm going to put here cash paid for purchase of land. Okay, and because I paid for that land in cash, that is going to be a decrease of 500,000. It also says that we bought equipment. So let's look at our equipment account. Okay, so we had equipment of $1,200,000 last year, and this year we have equipment of $1,400,000. Okay, so this year we have $1,400,000. Last year we had $1,200,000. So that means that we bought equipment worth $200,000. How do we pay for that equipment? It says on letter B that we paid for it with cash. Okay, so here I have cash paid for purchase of equipment. Okay, and because I paid the equipment for cash, that's going to be a deduction because we are accounting for what happened to my cash as a result of this transaction. Well, I paid cash for it, so my cash decreased. Okay, now let's look at this. It says purchase and sell of fixed assets. Okay, purchase and sell of fixed assets. What else happened? Okay, look at letter A. It says that we sold investments for $175,000. Investments is a fixed asset. Okay, so we have to record in our investing activities that we sold that investment. Okay, and we sold it and we received cash. So we have to put here cash received from sale of investments. Okay, and we received cash of $175,000. Now in the investing activities section, we are recording the cash received from the investment of $175,000. That is why we deduct the gain on the sale from the operating activities section. That way we don't double dip basically. We are accounting for it in the investing activities. So we are deducting that gain that was reported in our income statement. We are recording it and we are deducting it from our operating activity section. Okay, that way we record it in the proper category, which is the investing activities. Okay, so those are the three things that happened. Now we can calculate, let me do it up here. We can do our net cash flows used for investing activities. Okay, so we're going to add those three together and let's see what we get. So we get a negative 525. Okay, so let me format this over here. That way we can see this is my other section. Okay, so we spend quite a bit of money in our investing activities. Okay, we spend money on land and on equipment. Okay, we spend more than what we received. We sold an investment, but then we used a lot of our money that we generated from our operating activities to purchase some land and equipment. Okay, the next category that we have is cash flows from or used for financing activities. Okay. Okay. So let's look at financing. Okay. Cash flows used for financing activities are the cash flows from transactions that affect the debt and equity of the company. This could include issuing or retiring equity and debt securities. Okay. So let's look at our transactions. Okay. Letter C says that there was no disposal of equipment during the year, so that is done. That's just general information. We do not have any disposal of equipment. Okay. Now, letter D. Common stock was issued for cash. If we issue common stock, that goes under our financing activities. We can either make money by issuing stock or by getting a loan. Okay. So, in this case, we issued some stock. Okay. So let's look at letter D. The common stock was issued for cash. Now let's look at our common stock. And when we look at common stock, we have to look at two accounts. Okay. Let me highlight them here. Okay. The first account is just our common stock. Okay. We are selling our common stock at $4 par. Okay. So that is the actual market value of our stock. Okay. Now if we look at our common stock, we had 600,000 last year. This year we have 700,000. So that means that my common stock increased by 100 grand. Now let's look at our paid-in capital in excess of par account. Okay. What is the paid-in capital of excess of par? Okay. So basically the paid-in capital in excess of par is the difference between the fair market value paid for the stock and the stock's par value. So in other words, it is the premium paid for an appreciated stock. Okay. And basically the paid-in capital in excess of par is created when investors pay more for their shares of stock than the par value. So it's a stock that people are really wanting, it's desired, and they're willing to pay more than the market value to obtain these stocks. Okay. So in this case, we had 175,000 in our paid-in capital. Okay. And then we have 200 this year. So it increased by 25,000. Okay. So my common stock this year is 700,000. Last year was 600,000. My common stock account increased by 100,000. Okay. My paid-in capital account this year is 200,000. Last year was 175. So it increased by 125. So we have a 100,000 increase from my common stock, and we have a 25,000 increase from my paid-in capital. So that means I have an increase of $125,000, and this is actual cash that we receive from the sale of common stock. So you combine both increases in common stock and increases in paid-in capital. Okay. So we have cash received from sale of common stock. Okay. And we have $125,000. Okay. Now, we have to look also, it also says issuing or retiring equity and debt securities. That includes paying dividends. Okay. Did we pay any dividends during the year? Okay. And if we look here, letter F, okay, it says that there was a 90,000 debit to retained earnings for cash dividends declared. Okay. So we declared 90,000. We were going to pay out 90,000 in dividends. Now, let's look at an account that we have over here. We have to be very precautious. We have a dividends payable account, okay? So that is dividends that have been declared, but for whatever reason, we haven't paid them out. Either we can't get a hold of the stockholders or something's going on. So this is money that we owe our stockholders for dividends, okay? Last year we had 25,000. This year we have 30,000. So my dividends payable increased by $5,000. Okay? So that means that when we issued out our dividends or declared our dividends this year, we declared $90,000. We paid out not $90,000, but we only paid out $85,000 because we put $5,000 into our dividends payable. We weren't able to get a hold of certain stockholders or whatever the case might be. So we put those $5,000 aside for when we're able to contact them or get a hold of them or whatever the case might be. Okay. So if my dividends payable increased by 5, that means that I did not pay the full 90,000 in cash this year. I only paid 85,000. Okay. And the 85,000 is coming because I have $30,000 this year in my dividends payable. Last year I had 25,000. So my dividends payable increased by 5, telling me that I did not pay the full amount of 90,000. I only paid 85,000, okay? Which is the 90,000 minus the 5,000 that were put into my dividends payable account. So that means I only actually paid out in cash $85,000, okay? And we are looking at the 90,000, and then we're looking at the dividends payable account because it increased. That is telling me that we didn't pay out the full $90,000. That means that we put in $5,000 into my dividends payable account, telling me I did not pay out the full $90,000 in cash. I only paid out $85,000 in cash, okay? And cash paid for dividends. Okay. Dividends. Okay. And because it's cash being paid out, it is a decrease. Okay. We are paying money out. Money is leaving. Sorry about that. Money is leaving the organization. There we go. 85,000. Okay. So that is all we have. Those are all of the transactions that affect my statement of cash flows. Now I can get my net cash flows from financing activities. Okay, and we're gonna add those. Okay, and that gives me $40,000. Okay. So we've got the total for each of the section. Net cash flows from operating activities, $490,000. Net cash flows from investing activities, negative $525,000. And net cash flows from financing activities, $40,000. Okay. Now we have to figure out if my cash increased or decreased during the year. Okay, net increase or decrease in cash. And it just depends. If it's a positive number, it's an increase. If it's a negative number, it's a decrease. Okay, so we're gonna add our three totals: 490 plus negative 525 plus 40,000. Okay, and that gives me an increase in my cash of $5,000. Okay, so cash increased by $5,000. Okay, now we're gonna we're gonna make sure that we did everything correct. In accounting, we always have like a way of calculating if what we did in the statement of cash flows is correct, if our numbers coincide. So we're gonna start off with our cash balance, January 1st, 20Y3. We're gonna start off with the cash balance last year. So let's look at our cash balance last year. I'm sorry, this is 20Y3. This is this year. Okay, so no, that should be, I'm sorry, last year, December 31st, 20Y2. Okay, or it could be whatever our balance was December 31st, 20Y2, the beginning balance this year would be the same number. Okay, so we ended up December of last year in 20Y2 with $150,000. So that means the first day of 20Y3, which is January the 1st of 20Y3, that is our starting point, $150,000. Okay, so that is my beginning balance. We pick up the balance from last year as our starting point. Okay, 150,000. Now, what did we end up with this year? We have our cash balance, December the 31st, 20Y3. So the whole year passed by, and what did we end up with? Okay, in cash. Well, we ended up with 155,000 in cash. So my cash went from 150 to 155. So I have 155,000. Okay, so if we add my net increase or decrease in cash, which is my $5,000 that we calculated based on all of the transactions for operating, investing, and activities, that gives me an increase of $5,000 in cash. If I add that $5,000 increase to my beginning cash balance of 150, that should give you your ending cash balance posted on your balance sheet of 155. If that number, okay, does not equal that number right there, okay, then we've got a problem. Okay, the whole point is for us to be able to tell on our investors. Okay, well, our investors always look at cash very carefully, and they see that cash went from 150 to 155, and they're gonna ask why. Okay, what's causing this? This statement of cash flows tells them what caused that increase. Well, Mr. Investors or Mr. Statement Users reviewing this information, we had an increase of 490 from our operating activities, outlining what happened. We invested 525,000. This is what happened. And then we had some investing activities and some financing activities of $40,000 because we issued some stock and we paid out some dividends, causing our increase of $5,000 in cash. Okay, we started off with 150, therefore we ended up with 155. Okay, so this number corresponds with our ending balance of cash on our balance sheet, so we are good. Okay, very important that you always make sure that your ending cash balance on your statement of cash flows ties to your ending balance on your balance sheet. Okay, that kind of confirms that you've done it correctly. Okay, this is a completed statement of cash flows. You will have a statement of cash flows on your test or your upcoming test, Please analyze the information carefully. Pace yourself. Use Exhibit 5 when you are creating your operating activity section of the statement of cash flows, which is the most difficult part. Please follow step 1, step 2, step 3, and identify whether you need to either add or subtract. Very common mistake students do is they put the wrong sign here, and then that will cause them not to balance down here. Okay, so read the information very carefully. Review everything that has been outlined in your book. There's great information, great examples provided. Okay, make sure you do not wait for the last minute to work on your assignments. Because remember, if you have questions on the weekend, I will likely not answer to the next available business day. Okay, so if you have questions, please try to get them to me Monday through Friday. Okay, so that is basically it for this lecture. Until next time, and please don't forget to complete all of your assignments timely. You have 2 attempts. I keep the highest grade. And these assignments are intended to help you practice, practice, practice. You're not going to learn by reading. You need to do it. Analyze the information, put it together. Okay? That is it for me today. Have a wonderful day, and until next time. Bye-bye.